Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. So let's get across what's happened on global markets. Investor sentiment being buoyed by the prospects of US-Iran talks resuming. While European equity markets finished mostly in the red, on Wall Street the S&P 500 and Nasdaq rallied after President Trump said that Iran wants to make a deal, even as the US military began a blockade of ships leaving Iran's ports. Now, by Monday's close, the S&P 500 had erased all its losses since the war began, rebounding close to 8% over that time. Well, tech again led the gains with the software index up around 5.5%, its largest one-day gain since April last year. AI cloud firm Oracle surging, Microsoft also gaining along with cloud software provider Salesforce, ServiceNow and mobile ad tech firm AppLovin, all moving higher. SanDisk jumped with the memory chip maker set to join the Nasdaq 100 index next week. It was a less than impressive start to first quarter earnings season. Goldman Sachs shares falling on concerns over weakness in fixed income, currencies and commodities trading revenue, outweighing its profit beat. Shares in Albemarle, the world's largest lithium producer, rallied after Oppenheimer raised its price target on the company. Excuse me, and US listed shares of Telix Pharmaceuticals jumped after revealing it will jointly develop cancer treatments with drug maker Regeneron in a deal valued up to $2.1 billion US. Well, the US military has begun a blockade of ships leaving Iran's ports, while Iran has threatened to retaliate against its Gulf neighbours' ports. President Trump has said that Iran wants to make a deal and he'll not come to any agreement that allows it to have a nuclear weapon, saying Iran will not have a nuclear weapon. We can't let a country blackmail or extort the world. And the war in the Middle East will dominate global finance official talks in Washington this week. World Bank President Ajay Banga, though, saying that he's warned of another developing crisis, the huge gap in jobs for the 1.2 billion people who will reach working age in developing countries in the next 10 to 15 years, saying it's estimated those economies will generate only about 400 million jobs, leaving a deficit of 800 million jobs. Well, in choppy trading on the Treasuries market, the US 2-year yield was at 3.78%, the 10-year falling to 4.29%. Australian 3-year government bond yields fell to 4.67%. The 10-year was at 5%. The US dollar index down slightly on the day. The Aussie currently trading at 71 US cents. Well, oil prices climbed about 4% after the US military began a blockade of ships leaving Iran's ports. And more countries have announced emergency support measures to combat rising energy costs, while OPEC lowered its forecast for oil demand in the second quarter by 500,000 barrels a day. And the head of the International Energy Agency has said member countries are ready to release more barrels from reserves, though he hoped it would not be necessary. However, Brent futures settling lower at around $98 a barrel. Gold slipped, pressured by a stronger US dollar and renewed inflation concerns. Spot gold currently around $4,740 an ounce. Copper rose more than 2%. Iron ore up around 1% to $108 US a ton. And Bitcoin, that's jumped. Currently at $74,500 US. Well, let's get across all those market moves now. We're joined by Chief Strategist at Interactive Brokers, Steve Sosnick. Steve, welcome back. Good to see you. And despite what we're seeing, the failure of any resolution and those talks over the weekend, the blockade from the US military there, markets just want to go up.
Good morning, Andrew. Yeah, you just said it. They just want to go up. You know, traders just want to have fun, I guess. You know, the way that I put this to someone today, and I think I put it to you in my notes to you, was suppose 6 weeks ago I told you that crude oil was going to be $30 a barrel higher, bond yields were going to be 35 to 40 basis points higher, and we were going to take 50 basis points of easing off the table. Would you have said stocks would be unchanged over that period? I think not. But it doesn't really matter right now. The stock market just needs something to grasp on. And that is, you know, why we rallied today on a couple of stories that, you know, didn't really seem to be the case. You know, at about 9:40, someone publicized a tweet from a New York Post reporter. You know, as we know, well, the New York Post is owned by Rupert Murdoch and friends and family, and that, you know, he's obviously very close to the president. And it said something about, you know, a deal might be reached as long as Iran doesn't enrich uranium. And even then, you know, the timing seemed very suspicious because it was 20 minutes before the blockade was supposed to start. And then it turns out the the reporter even backed off the story and said, I'm just, basically reanalyzing some old stories, but didn't matter to the market. And then later in the afternoon, the president, came out and said that they're negotiating with Iran. It's not really clear why, with whom or what was said or why it's any different than what was not said this weekend. But that, again, the market doesn't care about that. It just wants an excuse to go up right now.
Interesting. I was just looking at a note from the brokers JPMorgan and Morgan Stanley saying that recent market weakness has created opportunities for long-term investors. In fact, Morgan Stanley is saying there that recent sell-off, particularly in the S&P 500, looked more like a correction than a prolonged downturn, particularly attributing that to improved earnings and healthier valuations. I mean, how do you see it?
Well, if you'd bought 7% ago, it was a great opportunity for investors. Right now, it's not so clear to me that things are meaningfully better. But there's of course the giant but, and that would be that earnings season really begins in earnest. Today we got our first earnings, as you noted at the top, was Goldman Sachs. I think David Solomon wants to try to beat Jamie Dimon out of the gate because it's typically JPMorgan that leads. But the market didn't love it. They had good equity trading business and a little bit weaker bond trading business. And that actually tells you, and you and I have discussed this many times, where I'm not a big fan of these big banks going first, because how is equity trading and fixed income trading relevant to anyone other than big banks? But we're really going to hear from JPMorgan and Citi and some other big ones over the course of the week. And I think what people want to hear is, number one, what is this doing for businesses, their business clients? What are they hearing from their individual clients? And what about private credit? Are there strains that they're seeing? Jamie Dimon particularly has been very vocal about it. Goldman didn't really address it too much. Let's see what they have to say about these topics. But in and of themselves, it's more about the basic economy and the banking business than just some trading results and investment banking results.
So what should you expect, particularly for those earnings expectations there? Are they likely to continue to grow despite what we're seeing with the conflict?
Well, right now, earnings expectations are expected to grow by about 12% across the board. That's a big number, and obviously, if we can manage those kind of earnings, that justifies the type of rally that we had. I do offer two important considerations, though. Number one, if everybody's already expecting 12%, you have to do better than 12% because that's priced in. So that's a very high hurdle. We've not really heard any profit warnings. We've not really heard anybody take down guidance. As I put it to someone last week in a podcast, the CFOs have the greatest excuse of all, because they can blame anything on this conflict because it's even better than the bad weather that they had to start the first quarter in North America. So, there's a lot of built-in excuses, and so if the market remains in a charitable mood and companies deliver, that's wonderful. If companies do not seem to be delivering and do not seem to be meeting their guidance, that'll get a little nasty. But probably the banks get through this unless there's some real, minefields among their credit holdings, which I don't really expect.
So the banks, of course, leading as they do to kick it off. But Steve, which sort of sectors are you actually keenly going to be watching across earnings season?
I want to hear what the consumer has to say, because they're the ones specifically most affected by this. Obviously, the more gasoline you consume, the worse off you are. We heard literally the worst consumer sentiment numbers from the University of Michigan ever in the 60-year history of University of Michigan consumer sentiment numbers. Inflation expectations jumped by a full percentage point. The number of people complaining about affordability was at an all-time high, and that grew. And the problem there was, that was sort of in a subtext. That wasn't really one of the headlines. But the problem, I think, that is occurring for most people is, yes, inflation is going down. It's not down where the Fed wants it yet, but it's better than where it was. But the problem is, as you know, and your viewers I'm sure know, lower inflation just means that prices are going up more slowly. And people in the U.S. are getting very frustrated about the fact that prices have never come down. They're persistently high, and especially now when you throw in the price. Sorry about just throw in the price. A wasp just flew through my set. That's bizarre. The Basically the price of gasoline is getting people. And I happened to take an Uber the other day, and the guy was basically just complaining about how much more it costs him to to do his work every day. It's hurting people. So this is what I want to hear is from consumer stocks. What are the consumers saying? Because it is still roughly 2/3 of the U.S. economy.
Well, that's playing out here too, Steve. In fact, fuel prices here are even more eye-watering in the way they've gone up, particularly for diesel, and that obviously affects industry and agriculture as well. Look, great to get across what you're seeing there stateside. Thanks for joining us from Interactive Brokers.
My pleasure, Andrew. We'll talk again soon. Take care.
So let's turn our attention to where we're likely to open now. SPY futures there, look at that. S&P ASX 200 up 1 1/3%. We shall see if that actually materialises when we get underway in just a couple of minutes. But obviously, as we're talking about there with Steve Sosnick, markets essentially now shaking off those risks they're seeing with geopolitics and powering ahead with a focus on Wall Street there, particularly with earnings season, which has now got underway. Stay with us. The Open just a couple of minutes away.